This is Bill Imany.
And this is Peter Purcell. And this podcast is brought to you by Trinergy.
By us.
By us.
Yes.
Right. The non-traditional consultants.
Well, Peter, today I've been thinking about energy service companies, the companies that service our energy industries, all the way from the oil field to the service companies that are out there helping with utilities and even the refineries and the like. So I'm thinking about them today.
Well, that's funny. I was thinking about them as well as I was driving in today and, looking at power lines overhead and gas stations and stuff like that. How necessary.
And they are the people and the equipment that are enabling the transmission of energy to our households and to our office buildings and
right.
to our cars.
Or enabling, energy to be pulled out of the ground and processed, refined, etc.
Exactly. And I will tell you, one of the biggest challenges these energy...
Job costing!
You're not even going to let me finish. Energy service companies struggle with is job costing, measuring job profitability.
Right.
So when they send a team, a crew out to the field to go service a well or to operate a drilling rig or repair a transmission line, that's a job or that's something they go do, and they've got to make sure whatever they're doing is profitable for their stockholders.
Well, absolutely, because if it's not profitable, they can't do it, right?
Well, of course.
So let's talk about it. I mean, if you say job profitability or job costing and
let's talk about job profitability. That's what they're really after.
Exactly.
How do I measure that? And
well, isn't it simple? Capture my cost, and then I bill out, and the difference is my profit.
Yeah, you obviously have never done any type of financial analysis or accounting before.
No, that's why I'm not allowed to use Excel at the company, right?
Yeah, that's right. Well, today we'll talk about what we mean by job profitability. And typically the hard part of this, and we'll focus on this, is how do I understand the costs of servicing my customers? And the revenue piece is easy. It's the amount that you bill your customers, your price times your units, and your units are sometimes measured in terms of labor hours or equipment hours or even materials that you use on a project or job that you do for your customers. So we're going to focus most of our conversation on the costing side of this, on how do I cost it?
Perfect. Yeah, because, I mean, for the two listeners that are out there, all joking aside, whenever we do an ERP project for an oilfield services company or a utility services company or just a services company in general, job costing and job profitability is a huge issue. And we spend a significant amount of time working through that issue during the design phase.
Yeah, and the first question we have to ask, and we always ask, and typically ask operations and the leadership of our clients, is what are you going to do with that costing information? So in other words, is it going to impact pricing decisions for your customers? Is it going to change the services you decide to focus on? Will it change how they allocate resources and what they do, or their investment strategy and what companies they buy? So typically, understanding job profitability drives strategic business decisions on how they're going to price, how they're going to go to market, how they're going to allocate resources, and where do they invest from a internal growth perspective, and what service lines do they focus on. Obviously, if you're a diversified services company, you want to focus your services on the most profitable jobs and the types of jobs, right?
Right. And then I think just to add on to that, it's not just what do you want to do, but how do you do it? Because it's one thing to say, I want to capture all these costs. You have to realize there's a human component at the back end. Because depending on the level of detail that you want to capture, you need to have your crews have the right tools, the right processes, and frankly, the right training to do it. So as you make these decisions, you also have to think about what's the impact down line.
Right. So the first question you need to ask is, how do they want to slice and dice the information?
Right.
And is it by service line? Is it by individual team or crew? Is it by management structure within the organization? By geography? By business unit? By entity? What are the different ways the company wants to see, I'll call it job profitability?
Right. And at what level of detail? Right?
What level of detail? And that's where it can get tricky. Because a lot of times they'll want to see it multiple different ways. They want to see it by service line, by customer, and by, let's say, crew or team of people that are actually going out and delivering the work. Or they might even want to see it by piece of profitability by piece of equipment that they have. So again, it all depends on how the company wants to see that. That's the first question that's asked. Okay? And that's usually pretty simple. Most companies already know that. They already know what they want to see and how they want to see it. The real tough part is, how do I do this, right?
Right. How do I get equipment profitability? You know, how do I get crew profitability? How does it happen?
Yeah, and so many times we'll walk into an organization and they'll say, I want to see job profitability down to the net income or EBITDA level. And a lot of cases you'll go, well, okay, that requires a lot of work. What decisions is that going to drive? So fundamentally, our philosophy is first start out at the basic level of saying, okay, I've got revenue and I've got direct costs. Those are the main components. And then you can start layering in other things on top of that. But we'll talk about the direct cost piece first, which are the actual activities that change when I go and do a job or a
So
project.
would those be things like labor and consumables and stuff like that?
Labor, consumables, and equipment are the main things. So
Okay.
if I'm a workover company, I've got a rig that I go use for a number of hours per day and a number of weeks over time. I've got people that are on that crew working on that rig. And then I've got, as you said, consumables. I've got tools, I've got parts, materials, and the like.
Fuel, soap, dope, and rope, for the oilfield services folks. And then, in energy services for utilities, it's wire, and wire.
And a lot of it's tools too that go onto
Right.
their vehicles that they use. So being able to capture on the revenue side, obviously you're capturing, for most service companies, you're capturing people's time that you're billing, and you've got billing rates you agree upon. And then you've got equipment time that you're using equipment for, because that consumes resources. It consumes fuel, it depreciates equipment, and it requires energy to produce those.
So you even have to take into account fancy word depreciation too.
Well, yeah. So let's talk about this for a minute.
Okay.
So when we talk about costs, the big debate that always happens in a job costing or project type environment is, how do I get as accurate as possible on my job costs? And a lot of companies say, what I want to do is I want to actually have my direct costs, all my actual payroll costs, go to every single job. And I want my actual equipment costs to go to every single job. But then there's complexity in that, right?
Well, yeah. And so the question that I would assume that the company would have to ask is, you can track all those things. We can always track all those things.
Yeah.
But what is the level of effort to track that versus the benefit of going to that level of detail? Like, why wouldn't you do standard cost bill? Or why wouldn't you do actual costs for certain things that are real obvious and then standard costs for others? I mean, those are the types of questions, right, that you would ask maybe?
They would be. And typically, let's talk about, just for example, let's dive into people costs. Maybe I've got 5 mechanics that are going out on a job, and they all make a certain amount of money. Maybe not the exact same amount of money. Maybe one enrolled in benefits, another one didn't. Maybe one of them gets a higher pay rate than the other one because of his experience level, but
or she negotiated a better rate.
Yeah,
or a better salary.
Exactly. So I've got these 5 people that are out there, and they're out there on a project for a week, and one of them takes a day vacation. How do I account for that? Do I stick it on the job they just left or the job that they're going on? What about time between jobs? And so that's where companies have a lot of challenges and difficulties, is they're trying to figure out, how do I take that salary cost that's actually calculated out of my payroll system and stick it into a job when maybe I've worked 5 jobs that week, or maybe I changed jobs in the middle of a week.
Worse, middle of the day.
Yeah, middle of the day, exactly.
Yeah, so I work 3 hours here and I work 7 hours there, or 5 hours there, or something like that.
So as a general rule, we try to, when we start talking about actual versus standard costs, typically you see actual costs in more project-oriented, longer-term type project. If in general, I'm a service...
And you would define a project as being longer than a week?
I would say over several months. It might even be a year. So let's say I've got a long-term contract with a customer, and all I really care about is that contract with the customer over the life of that customer, and maybe that's a year. And it might be one big project, or it might be a series of projects. But if I don't care about tracking the series of projects, and I just need to track the cost of profitability of that customer project, as I look at it as the company, then we would advocate for more of an actual costing type scenario, where then I can just basically say, okay, I'm on project XYZ. These 5 people aren't. They're on there the whole year. Basically,
well, then I can get accurate. I apologize for cutting you off, but what you're describing to me is I can guarantee accurate cost numbers on that type of project, whereas it sounds to me On a shorter, like day rate type thing, it would be harder for me to calculate my true actual cost easily.
Well, it's not a matter of day rates. It's a matter of how
I'm
detailed
sorry,
you
I
want
didn't
to
mean
see
day
it.
rate. I meant, sorry guys, really just a shorter job, like a day-long job or
Or
a
a
2-day
week-long
long
job.
job or a week-long job. I can see where even I could have a crew member bounce between two jobs all week.
Right, but if I want to
and
track
how do
those,
I track that actual cost? What a nightmare.
if I want to do that.
Right.
Now, an organization might look and say, you know what, that longer term customer project, I don't need to see the individual job profitability. Maybe I bill it at a granular
Right.
level, but I don't need to see that. But I just need to see that overall customer project. Then you can stick actual payroll costs in there by
Right.
just assigning that in for the whole life of that project.
Right.
And so when they go on vacation, that vacation cost or the benefit costs and all those other, I'll call it sick day costs, all get accumulated into that project over the life of it.
Okay.
And so the same thing holds for equipment too.
If I take a piece of equipment out and let's say in a big project like the one that you're talking about, I know it's always going to be committed to that project. So I can all my maintenance costs, all my runtime costs, all my depreciation. See, I caught your depreciation thing. I can apply to the larger project. But if I'm at a smaller, like I'm just doing a week-long gig or even a 2-day long gig, how do I calculate out what I really used? How much was it really just on the road vis-a-vis? How much was it really being used versus, I don't have to do maintenance for another month. How much of those maintenance costs am I going to apply back to this particular job?
Right, because I have that on that longer term project and I'm
Exactly.
looking at it longer
Exactly.
term. And by the way, the depreciation piece of it, the accountants don't have to go in and change the where the assets depreciated every single week. It's just once a year.
Oh, yeah,
or once
because you're
every
talking
several
about
months.
locations there too, right? Because in Louisiana it's different than Texas than in Oklahoma.
Yeah,
Right? That's
not-
a whole added.
Yeah, somewhat. I mean, it really
Okay.
depends. That's you're getting into a whole different thing around
I know.
regulations.
I was
and
trying to
everything.
sound smart.
Yeah, well, but focusing back on the cost piece of this,
Yes.
Peter, when we start thinking about capturing actuals, that's what everybody wants to do. They want to see the actuals because they said, look, I've got these 5 mechanics out here or 4 linemen, and let's say they operate in a different state, they got to pay state income taxes or they get paid more in that state.
Right.
They want to, I want to see how much more, how it impacted my job profitability.
Right.
But at the end of the day, whether you use somebody that was located in one state versus another, really matters is, am I making the right pricing decisions? Is this job profitable? So whether you have a higher paid or lower, just so happened to one project's got a higher paid mechanic versus another lower paid mechanic, that all comes out in the wash at the end. So the real question is as a company, how do I manage that effectively? Let's say I'm a company that has a lot of, I'll call it shorter term projects or jobs that maybe I've got individuals going from job to job within a pay period.
Right.
And so what we advocate for is using standard rates, standard costs, if you need to measure at that more granular job level. So even if you have a longer term customer you're working with and you have 50 projects you're doing with them, and the crew move between different projects over time, even within that, and they need to measure that profitability at a lower level, or there are companies like oilfield service companies that's a group of guys are going to go out and service a well one week, next week they're going to service another one, and maybe halfway through that week they go to another one, and they're 3 different customers and they need to measure that separately. That's where the whole idea of standard costing comes into play for energy service companies, because then I've got a standard price that I charge my customer,
Right.
but then I have a standard cost rate that I charge to that project. That is one of the leading practices for, I'll call it standard costing for jobs or projects.
And then you wouldn't, in a case like that, when you start setting standard costs and the like, you wouldn't have to go back and necessarily revisit what you're calculating unless you've had, a huge increase in salaries over a certain period of time, or, a huge increase in when do you revisit those?
Okay, but here's the reality, okay? So the first question is, what do I include in that standard rate? Okay, so let's think about
Fair
equipment. I might have a piece of equipment that's a rental. So that might be straightforward. I might know that a piece of equipment, a rental, it's expected to be used 40 hours a week, times 4.3 weeks in a month. And then I can say, okay, the monthly or hourly cost for that divided by the rental cost per month is X, and I can come up with a rate per hour for that rental. But then I have maintenance costs. I've got insurance, and maybe I have an asset that's fully depreciated, but it requires additional maintenance on it than other ones do. So what we advocate for is looking at your, for example, equipment, and looking at classifications of equipment to say, I've got a rig, I've got a digger, I've got a pickup, or whatever it might be. Those items have come up with a standard average cost for those.
Truck, yeah.
Exactly. A standard average cost for each one of those, and say, this type of rig, workover rig, we're going to charge that project based upon the life of its cost and its history and its maintenance, a rate for their usage.
fair
so it
enough.
might maybe a weekly rate or a daily rate.
Okay, fair enough. So what I'm reading between the lines, if it's equipment for standard cost, I might have a bucket truck that I own and a bucket truck that I rent. And I might have different standard costs for each of those, but bottom line is I run a standard
I would say you
cost.
might have the same standard cost for that.
You could.
What you don't want to do is get into where crews are
gaming the system.
Going, I'd rather pick that old one than the new one.
Fair enough.
And so they're not thinking longer term, and they're hand-picking equipment. So you might have a standard rate for that. The point is, what happens invariably when a company first sets up their standard costs, and they start adding up what the margins have accumulated, and then they add up on the other side of it the actual costs that happened in that time period, there's a difference.
Yeah, so what do you do with that
So
difference?
accountants love to just figure out a way to allocate it. The question is, what does that do? Really, what should be done is analyzing that difference, maybe booking that to, I'll call it a overhead account, and just knowing that's a variance account. And then they need to go back and adjust the rates accordingly to basically capture the over or under. So what you'd want to do when you first implement a system like this is watch it on a monthly basis and make adjustments on a monthly basis. But then once you get down, I'll call it to a cadence where you know the numbers are good and you're watching macro things that you're talking about in terms of price increases of equipment, inflation. Right. So what does it cost to change oil in a truck? That type of thing. Then you start getting closer, but it's not going to be exact. Accountants don't like it as much because you're not exact, but it gives management and executives the information they need to know whether they're making money or losing money on jobs.
Well, but it circles back to the very beginning of what you said is, why are you doing job costing in the first place from a strategic perspective?
Right.
Why?
Pricing?
Because is it for pricing? Are you really not going to take a job if you want to make money? But you're not going to make a pricing decision on pennies on the dollar.
No.
You're going to make pricing decision on a much more macro level.
But it helps you decide where you're going to focus.
Exactly.
And maybe you have a resource and a piece of equipment that's sitting out there going, it can go on this type of project or that type of project. And I fundamentally know on that type of project, I'm going to make more money.
A bucket truck on storm recovery is going to make a heck of a lot more money than a bucket truck on just installations and hookups.
Right.
So I'm going to want to put them more on storm recovery than I'm going to be putting them on, and I'm going to do the same with crews too, right?
Yeah, so there's a lot of decisions that need to be made when you're deciding where you're going to put resources, and it's a tool. Now, here's the next piece where people get into this. They go, well, I want to see net income, because we're just talking about margins. We're talking about we're talking about revenue and direct costs.
Right.
And then there's, I'll call it the other operating expenses. Like I've got operational leadership that, they're involved in managing all the different pieces of equipment. There's a maintenance, there's shops, there's warehouses, there's all those costs.
So how do those costs get allocated?
Well, it's interesting. So we get this debate. So companies will go, well, we need to allocate it based on revenue, which is fine. That's easy to do. And you can do that. Simple enough, right? But then you ask, well, what am I doing by doing that? Am I just allocating it peanut butter?
Why? Yeah, exactly. Why would I allocate a truck's cost based on revenue? Wouldn't I want to allocate based on runtime? Because that's really...
Well, no. We're talking about overhead here. We're not talking about direct.
Overhead. I'm sorry. Yes.
I got a warehouse.
Fair enough.
Me,
Yeah. Folks in the warehouse.
And there's tools in there, and I got people there.
Etc.
I've got mechanics. I've got people that aren't assigned to specifically direct costs. Yeah. And so what we recommend is, you could do it by revenue. That's one way to do it, to keep it simple. The other thing to ask yourself is, if I've got different service lines, and let's say certain service lines use the warehouses more than other ones do,
then they should get more allocation.
Maybe they get more allocated.
Right.
So it really depends on the company's philosophy and what are they trying to
Fair
achieve.
enough.
I'm always one to say, don't do an allocation unless there's some regulatory reason for doing it. Or
why is that?
Why spend the money doing it? And why run an allocate? Why? If I said to you,
well, it guarantees the accountants a job. It gives them something. They can be creative now.
They don't like the accountants. Truly, if you ever ask them, they really don't like doing allocations because it's a pain. They'd rather just get the P&Ls out. Yeah. But in a lot of cases, and I remember as a young accountant, we created these P&Ls a long time ago.
Okay.
We created these P&Ls and we had this allocation. And everybody's asking, well, why'd it go up? Why'd it go down? Yeah. And what the accountants really need to be focused on is eliminating all these accruals and things like that and out of period costs and focusing on
Right.
keeping the costs in the right time periods, revenue in the right time periods, collecting and billing accurately, doing that, then you don't have to worry about all these anomalies and trying to explain weird stuff that's happening. But a lot of times, I mean, I've seen this before, operational guys will look at that allocated number and just kind of hide it, ignore it.
Right.
So then the question is, well, how do I measure something's really profitable? Well, an organization knows. So for example, if they know overhead is typically 20% of revenue or 20% of my costs,
Right.
then you know that I need to have at least a 20% margin if I'm making money on something.
Correct.
So
You would think so.
So use those numbers in the pricing process and
Yeah.
saying, okay, it looks like, for example, G&A.
Mm-hmm.
I can allocate G&A to projects and jobs, but it doesn't do anything unless I'm making different decisions with it. However, when you're pricing projects or jobs and you know G&A is 10% of costs, and your pricing models need to say, hey,
You got to get at least 10% or
cover
else you
10%.
shouldn't be doing it.
Right, exactly. So
Right.
that's where a lot of these decisions come into play, is creating standard rates, creating comfortable with those standard rates, and having some good margins that you're looking at, and using those rates in your pricing, but then also using those rates in your systems as well.
Okay, so the elephant in the room is I'm going to have like listener number 2.5 who's half listening right now because they're driving and cursing at somebody next to them. They're going to say, well, wait a minute, not every job I have is the same. So how can I use standard rates? And if that's the question, then the answer may be, well, step back and maybe refocus a little bit on what we're talking about is setting standard rates for the different components of the job and work from there, right?
I would ask
right?
Well, I would ask the question: when you say every job's different, I might
have a different work crew. I might even have water hauling. Okay, so even water hauling, as simple as water hauling is, okay, which I know our listeners will scream at me and say it's not, but it is. It's simple business. I might have a different truck, different crew, different type of driver. I might have a different size crew going out, to set up the pump. I may have a different pump. I mean,
standard costs take that into consideration. I will have a standard cost for a water hauling truck, and I will have a standard cost
for a different horsepower pump.
Right, different. Yeah.
And then what about crew?
Well, the
what
crew,
happens in my crew sizes can be different every job.
Because then the standard rate is times the number of hours. So if I have a
There you
larger
go.
crew,
Okay.
or let's say it's a different makeup of the crew. Maybe a supervisor for a water hauling crew is a different rate than a supervisor for a workover crew. And maybe they make a lot more, a lot less money.
Okay.
Then you would have a different standard rate.
So it's
for them.
essentially by component of your job.
Or component of your business, and how you run your business.
How you run your business. That's essentially what you're looking at.
Right, but the standard cost is just the rate that you apply to the hours. So if I have more people, I'm going to be billing more, I'm going to be capturing more costs.
So as we go down this path, I got to ask the question, right? Have we done an analysis between here's a standard cost model for a company, and then here's their actual costs? And when you do those studies, how far off are you? Are you 5% in general? Are you 3% off? Or is it just so small that it's an immaterial
The
difference?
part where you're actually, what I find is on the direct side, you're not very far off if you do the standards right. Okay. The first time you do it, you're off because you realize, well, you know what? We forgot to include the 401k in the people costs.
Okay.
Or there's some tax thing that you forgot about. The part where you're way off is the allocations that are done versus how you should be doing. So I'll give you an example. We had a client where they were basically doing to all the different service lines of standard revenue allocation across the board. Okay. Then they found out that certain service lines were using more resources from an overhead perspective. So they actually did an activity-based costing exercise. They went through and said, based on the activity each service line is producing at an overhead level, these service lines per unit should be getting more cost allocated to them. So those made the difference. Now, that's only in unique situations where I have a clear-cut case for, I've got this service line that requires a series of distribution centers and warehouses to be set up and that I don't have assigned to a cost, whereas the other service line doesn't use the distribution centers and warehouses.
Right. Okay.
So I would allocate those costs to those distribution and warehouse costs to that one service line that uses
Fair
them.
enough.
That's the difference.
That's the difference. But once you get that nailed down, you find the difference probably is not that great.
Right, if you're doing it right. Now, trying to go through that exercise of actually comparing it live,
Yeah, and proving it out
is a very difficult exercise for the accountants, and probably would require them to bring a bunch of consultants in to do it. And you don't want to do that.
No, you don't. But if you had to, you could, but you shouldn't.
But the real question is at the end of the day, do you see a correlation between the profits you're making at a job level and a total company level? And are you seeing those cash flow improvements flow
Exactly.
through?
And then am I going to make the right decision about, should we even be doing these types of projects or not? Or these types of jobs or not? Or should I be doing business with this customer because they're trying to nickel and dime me down to the point where I'm not making any money? Right? I mean, that's what's important for capturing this information.
Peter, I'm surprised you haven't brought this up yet since you're such a tech head. The ERP system question.
Oh, yeah. Well, I was actually trying to get to that, but...
Well, it's time.
Okay, it is time because we are actually running late, but that's okay. So, elephant in the room. How do you implement this in an ERP?
Or do you implement it in an ERP?
Or do you implement an ERP? And the reason why I ask that question is, I understand on the bigger projects, all ERP have project accounting modules or project accounting bolt-ons. So that's easy to do, right? You have project number and you hit that, and you can capture your cost at that level. That's a no-brainer. But when I start looking at these smaller jobs and the job cost at a smaller level, even with using standard costs, how do I do that in an ERP system, or do I do that in an ERP?
I would recommend you do that in your ERP system, because here's the issue. When you don't calculate your direct costs and your margins outside your ERP system, the direct costs and margins that you have in your ERP systems don't tie to what you're looking at from anything outside the system. They're never going to tie.
Fair.
So what we advocate for is using that standard cost system to calculate your margins, your direct margins in your ERP system. And then you can use your ERP system to allocate those out in your general ledger or even into your jobs. You can do the allocations outside the system, like in Power BI or something if you wanted to. But the reality is we recommend trying to do it in your ERP, because then you get two versions of the truth. We had a service customer years ago. All they were capturing were their people costs in their margins. The equipment costs weren't in there. Okay, so they did this thing outside the system to figure out what their equipment costs were, and they could not tie it anywhere close to their margins.
Fair. I'll bet you their auditors had a field day on that. So, but here's a question for you. What this leads to then is that means that you need to do a pretty good job of field ticketing, right? So my work order,
capturing their time,
time, which could be in payroll or T&E system, time system,
or time sheet of some sort.
And then the equipment could be on the work order, or it could be on the timesheet. I'll be curious as to how that works. And
it's
then
the same thing. I've got a timesheet. If you've got a simple user interface that says, okay, I put in my time and I put my equipment time and my people time in one place.
In one place. What about consumables? So for those little bit of actuals that you sometimes
so
hit.
Consumables come from two places. Typically, they'll come from an invoice or purchase order,
okay,
or they'll come off of a P card that they're using. So in a lot of cases, a lot of companies will actually have P card be validated through some sort of T&E system, expenses system, and they put the project code on those items. On a purchase order, they put the job code or the project code on that invoice, so that when it gets paid, it gets charged right to that
Okay, that's
job.
for the larger projects.
Because a lot of those things are billable. They're going to want to capture that for billing that back to
and because in some
customers.
cases, you could be a pass-through. Right, where it's like, okay, the fuel cost, we're just going to pass it through. We're not going to mark it up.
I've seen in some cases in the drilling industry, they're buying stuff for
the company.
For the company, because they don't have the authority to buy it. So they're getting the service company to buy it for them.
But again, they just pass through the cost. So again, it sounds like that's making sure that your ticketing system is set up right, your T&E system is set up right, and then putting policies and procedures and training around all of that.
Yeah, the big thing is policies and holding the people in the field accountable for getting the information in quickly, timely, and having a good process. It all comes down to having a good process. You can create a standard costing system, but if you don't have enough on that back end, people getting the information in accurately, it impacts billing, your revenue. It impacts whether your customers pay you or not, and then it also impacts your paycheck. So I'm putting time in. It better get to the payroll system properly so they get paid.
Well, we did that with one of our clients. Is like, you didn't get paid if you didn't put your time in, you didn't validate it in a timely manner. And trust me, it would only happen once before that person was compliant the next time around. So it was interesting.
All right. Well, hey, Peter.
pre-
No, you asked some really good questions, and I
asked some really stupid questions too. Obviously,
be
for
nice.
those of no. For those of you out there who know me, I'm not an accountant. So when we talk about allocations, I start thinking about all those things that I cate, and that's an allocate, right? So anyway, what I would like to ask the listeners out there, if you have any ideas or you'd like us to cover any topics, just go ahead and email Bill or me. That's Bill or Peter at Trinergy.com.
It's not Bill or Peter. It's Bill at Trinergy.com
or Peter at Trinergy.com. Our listeners got that, but that's okay.
Well, just the two of them.
All right, guys. Later.